Cleveland, Ohio, October 1973, a woman named Dorothy pulls into a gas station on Pearl Road at 5 in the morning. The line stretches 3 blocks. A hand-painted sign on the pump reads, "For gallon maximum." Last week, there was no limit. The price has doubled in 6 weeks. By January, it will triple. Dorothy has $5,000 sitting in a savings account at Cleveland Trust. It pays 4.5%. She thinks that money is safe. It is not. Over the next 12 months, inflation will consume a third of its purchasing power. And nobody, not her bank, not her government, not her newspaper, will tell her until it's too late. Music builds now jump. Tehran, 1979. The Shah has fallen. Iranian oil vanishes overnight. All doubles again. The Dow sits exactly where it started the decade. A full lost decade for American stocks. Jump again. Baghdad, 1990. Saddam invades Kuwait. All doubles in weeks. Recession follows within the year. Same trigger. Same sequence. Same devastation for anyone holding paper. Every single time. Music drops direct to camera. Here's what keeps me up at night. Right now, as I'm recording this, the Strait of Hormuz is closed. Oil has surged past $100 a barrel. Analysts are saying $200 is no longer outside the realm of possibility. Iran has promised to make it happen. This is not theory. This is 1973 happening again, in real time, on a bigger scale, with a more fragile global economy underneath it. I'm going to show you exactly which 4 assets survived the last time oil prices exploded, and which ones went to zero. Stay with me. Disclaimer card. This is history, not financial advice. Do your own research. I'm the fiscal historian. I show you the autopsies. Segment 1. The pattern. Before we get to the assets, you need to understand the pattern. Because it doesn't just repeat, it follows the exact same sequence every time. A choke point closes. Supply vanishes. Prices spike. Inflation surges. Central banks panic. Paper assets collapse. And then the wealth transfer begins. From the unprepared to the prepared. 1973, Arab oil producers embargo the United States after Nixon sends emergency aid to Israel during the Yom Kippur War. Oil goes from $3 a barrel to $12, quadrupled. The stock market loses nearly half its value over the next 2 years. Recovery takes almost 7 years, not months, years. 1979, the Iranian Revolution pulls Iranian oil off the market. All doubles again. Inflation enters double digits. The Federal Reserve panics. By 1981, the 10-year Treasury yield reaches nearly 16%, destroying anyone holding long-term bonds. 2026, the Strait of Hormuz closes. 1/5 of the entire global oil supply vanishes. The International Energy Agency releases the largest emergency stockpile in its history. It barely moves the needle. The daily shortfall is 15 million barrels, the entire daily output of the United States. There is no easy replacement. Same choke point. Same spike. Same panic. The question is not whether the pattern is real. The question is, what do you own when it hits? Segment 2, the 4 survivors. Asset number 1. Gold. Here is what blows people's minds about the 1970s. Gold didn't just beat inflation. It destroyed every other asset class. And it wasn't even close. When Nixon closed the gold window in August of 1971, gold sat at $35 an ounce. By January of 1980, it hit $850, $35 to $850. In less than a decade, stocks lost purchasing power every single year over that same period. Bonds lost even more. Gold gained 9% annually, after inflation. The mechanism is simple. When energy prices spike, everything denominated in paper loses value. Gold is not denominated in paper. No government prints it. No government borrows it into existence. Here's a detail most people miss. 1 month before the 1973 embargo, OPEC passed a resolution complaining that the dollar's collapse had robbed them of revenue. They began pricing oil against gold, not because they loved gold, but because even the people selling the oil didn't trust the currency they were selling it in. Research by Hams and Wills proved something remarkable. Before the embargo, the price of oil measured in gold had already dropped by more than half. The so-called price spike wasn't purely political. OPEC was clawing back purchasing power. After the spike, the price of oil in gold terms returned to exactly where it had been. The crisis was a repricing, measured in the one currency governments cannot debase. Nothing actually changed. Right now, gold has surged past $4,500 an ounce. briefly touching $5,000. The pattern is active. Asset number 2, farmland. This one surprises people. During the 1970s, farmland was the second best performing asset class in America, behind gold. The USDA tracked it. American farmland went from $137 per acre in 1970 to $737 by 1980, more than 5 times the price in a single decade. And that doesn't count what the land produced. Beef prices doubled. Corn nearly tripled. Wheat quadrupled. The land appreciated and the output appreciated simultaneously. The mechanism. Modern agriculture runs on oil. Tractors burn diesel. Fertilizer is synthesized from natural gas. When energy prices spike, food prices spike with them. The cost of food rises, and the value of the land producing it rises with the cost. And unlike gold, no federal government has ever confiscated farmland during a financial crisis. Not in 1933, not ever. There's no executive order for farms. A government that seizes farmland creates a famine. Even tyrants understand that math. Subscriber call, midpoint. Quick pause. If you're realizing that the assets your financial advisor never mentions are the ones that actually survive oil shocks, hit subscribe. I'm the fiscal historian. I show you the autopsy so you see the patterns before they repeat. No products, no sponsors, just the historical record. Asset number 3, energy stocks with a critical warning in the long run. Energy stocks crushed the broader market during the 1970s. An equal basket of Exxon and Chevron held. Through the decade returned 5 times what the S&P 500 delivered. But here is the warning the history books leave out. During the very oil shock, that should have been great for energy stocks. The 1973 crash, that same basket lost almost half its value. Right in line with the broader market. Let that sink in. Oil quadrupled. Energy stocks still got cut in half. The mechanism. In a liquidity panic, everything sells. Margin calls don't care what you own. Energy stocks recovered faster and went higher, much higher. But you had to survive the crash first. If you sold at the bottom, the long-term returns meant nothing. The Nifty 50 proved the opposite lesson. Polaroid, Xerox, Avon, the blue chips everyone loved, trading at 50, 60, 90 times earnings. When the oil shock hit, they collapsed. Most never came back. Polaroid went bankrupt. When inflation surges, the market stops paying premium prices for future promises. It wants value now. Asset number 4, short-term government debt. Boring one. And boring saved a lot of people. Long-term treasury bonds were destroyed in the 1970s, a fixed yield that inflation ate alive. Every year, for a decade. But short-term treasury bills, the kind that mature in 90 days, in 6 months, kept up with inflation. They roughly broke even. Not exciting. But breaking even while stocks crash and bonds bleed is not boring. It is survival. The mechanism is maturity. Short-term bills reset their rates as inflation rises. Long-term bonds are locked in at whatever yield you bought them at. Duration killed bond investors. Short duration saved them. Segment 3, what went to zero now? What went to zero? Savings accounts. Dorothy in Cleveland. $5,000 at Cleveland Trust. The bank paid her 4.5%. Inflation ran at 12%. She was effectively paying the bank to hold her money. She just didn't know it. And here is what the history books consistently skip. The people hurt worst were not gamblers. They were the most conservative, most responsible savers in America. The people who did everything right, who saved diligently, who avoided risk, who trusted the system. They got wiped out, not by a crash, by the slow, invisible erosion of purchasing power, while their government told them everything was fine. Segment 4, right now the warning signs are visible today. The Strait of Hormuz is closed. The Strategic Petroleum Reserve can release 4.5 million barrels per day. The daily shortfall is 15 million. The reserve cannot fill the gap. It buys weeks, not months. Southeast Asian nations are already rationing fuel. Thailand and Vietnam have run dry at the pump. People cannot get to work. The mechanisms that helped contain the damage in 1974, spare production capacity, alternative suppliers, emergency reserves, are weaker today than they were 50 years ago. Closing. Dorothy waited 3 hours for 4 gallons of gas at 5 in the morning. She didn't know she was living through a wealth transfer. Nobody told her. The newspapers called it a shortage. The government called it temporary. Her bank told her savings were safe. Meanwhile, Bunker Hunt bought silver at $3 an ounce because he studied Weimar Germany and understood what happens when paper currencies lose their anchor. He was right, until he got greedy with leverage and the government changed the rules. But the instinct was correct. Physical assets outside the banking system held their value when paper assets did not. Dorothy trusted the system. Bunker Hunt trusted history. The pattern is mathematical. The outcome follows from the pattern. The only variable is what you own before it begins. That's it for today. I'm the fiscal historian. See you in the next one.